This is Macro Analytics, delivering frank conversations on global macroeconomics and market analysis, outside the mainstream, featuring discussions and debates between Gordon T. Long, publisher and editor of GordonTLong.com, and his guests. The content of this discussion is strictly the opinion of the participants. It is in no way a solicitation for business, nor is it to be considered investment advice of any sort. Always consult a registered investment advisor before making any investment decision. These discussions are extremely hard-hitting and terribly frank, and parental discretion is advised. Now, on to the show.
Good morning. I'm Gord Long with GordonTLong.com, and I have with me again this morning Ty Andros. Ty is the president of TraderView, publisher of the TEDBits website, and writer and editor of his well-recognized newsletter, also named TEDBits. Welcome back, Ty, to our second session here on mispricing and malinvestment.
Thank you for having me.
Ty, we left off in our last session after we defined malinvestment and mispricing. We had a discussion on what inflation is and how it really is one of the major contributors, or the misrepresentation of what inflation is. What we got up here is some examples. The list would take many shows to go through, but these were just ones that were so clearly evident here in the last 10 days in right front and center in the media. And if we go, and we'll go through, I'd like to work through these with you because I know you got some strong views on each and every one of these. But the commonality right off the bat is they reflect non-performing loans, monies that have been lent out that of massive amounts that are not producing. They were mispriced, and therefore have led to their malinvestments. They're not performing, and you can only roll those. You can only fudge the book so long if they're not performing. So as we go through these, I really encourage our listeners to think about this. What's happening with non-performing? How long can you hide a non-performing loan before you have to write it off, or you have to shut down something, or you have to formally call it insolvent and declare bankruptcy? Comments on that?
Not only are the loans not performing, but what are the asset values that back these NPLs? And they're in free fall. And there's just no way around it. And of course, this is just a small example of it. When you sit here and you look at $1.2 trillion of bad loans in Europe, that's understating it maybe by a factor of 10.
Yeah, these are already officially non-performing. I believe the bad loans is much, much higher. Because even in the United States, we have all sorts of residential real estate that is, we're not calling bad loans, but it is.
Yeah, exactly. I mean, just getting them to fess up to this amount is like pulling teeth.
This came from Price Waterhouse in Frankfurt at Ty. This was making its circulation around the German newspapers, which, by the way, you can see it's in German. It got quickly pulled and disappeared because people would start to react to it to see the magnitude of it. Now, as you really correctly point out, if a loan is non-performing, it says, okay, what's the underlying asset worth if it's not performing? And that's what's happening. The asset values are being brought down, even if not on the books, in reality. And where that shows up is if you want to refinance a loan, which you have outstanding, the lender is not going to lend the amount based on the original asset value. And so your collateral is collapsing. And what we have is a collateral contagion throughout Europe right now. That's the hidden.
But those values have to fall to a price where somebody can buy them and make a real return after real inflation. And markets always overshoot too, don't they, Gord? So these apartment buildings and businesses and commercial office space and whatever it is, they are actually going to have to fall to a point where they produce more than they consume.
We're like a plane right now at stall speed. We're out of momentum, we're out of growth, and we're just hovering there. We haven't plummeted. These non-performing loans are still on the books, but that's what's going to happen, like a plane when it stalls. And it will stall, and the prices will have to come down to be able to clear them from the books.
Yes.
That's the normal expectations.
But as you know, Gord, the problem is much, much larger than $1 trillion in Europe, or $1 trillion in the United States for that matter. These things just don't produce more than they consume.
Drahi would be excited if he knew it was only 1.2 trillion.
Yeah, his job would be about done.
Yeah, and as big as that sounds, I think there was numbers that were much larger than that leaked out a few years ago, as you recall, Ty, and were also immediately pulled. And they were talking about a $28 trillion problem at that time. You recall that?
Yeah, and I really don't think it's any smaller than that at this point, because the deleveraging really hasn't occurred yet, has it?
There's been some. There's no question there has been some. I don't know if it's been deleveraging. There's been just more hidden defaults that have already happened, but it's not been really managed deleveraging to the degree that it should. But you're right, absolutely. It's only beginning. Ty, another example is, and we can bounce right around the world. Here's China, and China, the amount of non-performing loans that it's seeing right across its industries and in its industrial sector. And what they're starting to expect, not maybe just China. You can see that there's indication that it's right throughout Asia. And some of the, the high-profile non-performing loan cases I'm highlighting here across various industries where they've actually, and Ty, believe it or not, went into bankruptcy. I mean, we do everything we can to avoid, quote, bankruptcy. But these are ones that are showing it, that are already happening over in China. Again, the magnitude of non-performing loans.
Well, when you see credit growth at 20 to 24% compounded annually, it's once again too many dollars and too much credit, chasing too few opportunities. And so those opportunities are massively overpriced when they do find a home. And one of the nice things that we really see here is that, at least these are great big cancer cells being taken out of the Chinese system. Bankruptcy is a cleansing process, and it cleans out all the foolishness and all of the over leverage, and hopefully takes you to a level where the entity or whatever it is can produce more than it consumes. And that just isn't happening here in Europe. I can't think of one thing where we've seen prices actually go down and stuff get transferred from weak hands to strong hands. An example would be General Motors. General Motors, in my mind, is still a dead man walking. They didn't change anything. It could have gone through a bankruptcy 2 years ago. Don't let anybody tell you General Motors was going the way of the dodo bird. Nobody in the world had flushed down the toilet something that's taking in tens of billions of dollars worth of business. They would go in there and fix it and clean out the thing so that the company can, have a bright future as well as their employees. Unfortunately, that is trying to be short-circuited over and over again. In that case, it was short-circuiting in a classic case of Chicago-style crony capitalism. Obama was paying back to UAW.
Yeah, it was the legacy of the pension plans and basically passing it to the United States taxpayer. But it's healthy when I see this chart here of China of bankruptcies. The capitalist system rewards risk. You get mispricing because pricing is about pricing in risk. So when you misprice it, you're mispricing risk. And when you have excessive risk, there needs to be a penalty that pays that says, okay, risk, you took too much, it failed, and therefore we clear it out, and it's called bankruptcy. We have disjointed the system. It's not self-correct because we've severed the line between risk and bankruptcy. Because of one bankruptcy, the collateral becomes a cascading effect. And you can only push that string so long. And as we've said earlier, non-performing loans start to grow. And they just keep growing until finally you can't hide it anymore.
Here the investors are being taken out and shot.
Correctly.
In the United States and in Europe, no such thing is happening.
Because the banks, and here let's go to Spain. Here's another example. They've lent ungodly amounts of money to exploding real estate, commercial and private, throughout Spain during these growth years. They're not performing. People are not paying. They can't afford those payments. The banks themselves have now got all these bad debts, so they should be written off, correct? Well, no. What you do is you paper the whole thing over, and now we're going to take the entire Spanish government that's backed it with it. And frankly, it's big enough, it's going to take the whole ECB with it, as opposed to have written off these bad loans earlier, 2 years ago, 3 years ago.
And of course, the deception never stops. I'm sure you read about the bad bank and moving the bad loans into the bad bank, but moving them in there at false values. And literally, they're talking openly about suspending accounting rules so that they're not ever going to place the correct valuation on them, and just hopefully they can get another group of suckers to come in there and buy that stuff at the wrong price. And most people don't know, but that when you have a bust with malinvestments, the first transfer is from one misprice to the next misprice. And it's just, who's the greater fool? They think they're getting a great discount, but actually the discount is nothing compared to where the asset has to fall to become, I'll call it a healthy situation that produces more than it consumes.
See, the first round of suckers, and we're talking Spain here, and were the ones that rushed in and said, when they started to fall, it said, well, there's going to be a recovery, or the government's going to bail it out. And so they started picking up some of these assets in not a broad-based way, but enough. And those are the suckers. And because there's a huge ways to go, and now it's collapsing. Now what's happening, and we have the bank runs that are just totally out of control, not only in Spain, but right across Europe as money's fleeing, because people have said the market clearing event has got to take these assets collateral down significantly further, and I've got to protect my buying power so I can come in here later on at 20 cents on the dollar. And that's what you see is a huge amount of positioning that's beginning to, and we're still early, Ty, in this, beginning to reposition itself, but well advanced in money that's fleeing the entire European market.
Yeah, where does it go?
Well, right now it's going to what is perceived as safe havens. Initially it was in France and Germany, the German banks. That's really has stopped. And it was also going to the U.S. dollar vis-a-vis U.S. treasuries. That has more or less slowed, but now it's fleeing to Switzerland in huge proportions. It's going to Singapore in huge proportions, and frankly other Asian countries as was flowing, and other tax haven countries. So it's flowing geographically, and it's also flowing into different assets.
Well, the one's different than the other. One is capital flight because they don't want to be, the suckers for the welfare states in the U.S. and Europe. Okay, I mean, how much of this is just, the rhetoric coming out of Brussels and out of Rajoy and everything else? They don't even want to be in the neighborhood when what these guys are going to try happens, and but they still don't understand what money is, and they're trying to store their wealth in something that is, I'll call it a phantom, an illusion. Of course, and this also argues for our bull market in gold, because ultimately that's the only thing that's not a promise to pay or an IOU.
But here, I have the U.S. insurance industry. It was an article that you pointed out in the Wall Street Journal here just a couple weeks ago, and it's indicative of, again, mispricing and malinvestment. In this case, with the games that is now surfacing of the coverage ratios that were adjusted because of all of the amount of insurance, real estate rather, the insurance companies own. And by the way, the article missed the fact that the biggest owners of commercial real estate that's in the United States is in fact insurance companies. They left that totally out. And we're talking about the magnitude of exposures that residential insurance has, but they had changed the coverage ratios quietly to be able to kick the can down the road, to be able to continue to misrepresent pricing on what are effectively malinvestments. And it's shown in the bottom. The coverage ratio really was about 15%, and they've taken it down quietly to only 3%. So who's holding that risk? Clearly, risk is seriously mispriced through these insurance companies.
Well, we know who's holding it, and it's the public who's got to guarantee these things, just like they did with the banks. So, but the bottom line is, what I see there is that they went from 1.61 to 6.7 to 1 leverage to 38.5 to 1.
Correct.
And it's a short hop, skip, and a jump to lose 3%. So basically, I would say that if they mark their assets correctly, probably the whole insurance industry in this part of their portfolio is operating in insolvency.
Like I said, it's really commercial real estate that without question is 30 to 40% lower than current book value. And they're the biggest holders in America is insurance in the commercial. Again, nobody's talking about it. Mispricing, malinvestment, non-performing. Insurance companies can hide this for quite a period of time. And we've been doing it for how many years now? 2008, 2012, going into 5 years.
Well, just to put that into perspective, that leverage, that's Lehman Brothers. That's
what Lehman went under at that kind of leverage.
Yeah, MF Global. But I would argue all the banks are operating in this kind of leverage.
Certainly, without question, in Europe, 50-1 is not uncommon. Keep on going. I'm showing the non-performing of HELOCs, and as you well know, because you wrote quite extensively about this back in 2004, 5, 6. The HELOCs were a dominant, this stands for home equity loans that were being taken out against people's residential real estate, kind of like a glorified ATM, but it was a dominant part of the United States GDP. So there was a huge amount of HELOCs. Well, houses are upside down. Mortgages, we all know the story there, but what's happening now is people don't have the money to pay for the HELOC loans that they took out, to add an extension on their house, to add a swimming pool. Actually, they were borrowing that money to pay for college and university tuition fees.
Well, that and vacations and all other sorts of foolishness that wasn't self-liquidating. But the bust is going to be greater than the boom. People say that the real estate problem is over. I would say that it's barely begun. And I believe that we have another leg down equal or worse than the one that we've had. And we really haven't seen it in commercial at all.
I agree with that, Ty, and I've showed many times charts that would suggest what you just said. But I was just looking at this one that I have up here that is showing just that we were to restore normal loan to values on household wealth in the United States. There's a $3.2 trillion problem there that's reflected in this chart. So we've got another leg down, and we've talked about this is household formations are not growing at any rate. They're shrinking because students can't find jobs. They can't afford houses. They don't have the capital, and they're moving back home, if anything. Let's just say that it's stagnant. Housing is not going to recover unless you have new household formations. That's not happening. Even immigration has slowed.
Well, when you have a Ponzi economy, the greater fools got to come along and take it off you, the asset off you for a higher price. And I would say that there aren't a whole lot of greater fools coming along. There is no wealth creation going on in the United States. This is, a disaster unfolding or a great opportunity, depending on how you handle it.
If you want to talk about non-performing loans, this is just showing the magnitude of the HELOC situation up here in the upper left, Ty. And what really looks all right is that bottom flat line, which is student loans on the top left-hand corner. But you can see, we all know the magnitude of student loans. It's now over $1 trillion. I believe you're going to see non-performing loans soon emerge, and we're starting to see signals of it within student loans. Now, the difference this time, Ty, is these are non-recourse, non-discharge loans, and that's going to get very, very ugly. But it's coming because the students simply can't find the work to pay for these loans, which come due and are payable in installments the day you graduate.
Well, it's a classic example of, best intentions. We all want everybody to be smart and have a good education, but unfortunately, it just doesn't work that way in nature. And that you're fully aware, Gord, that they handed those out just like they handed out subprime loans. And those people weren't qualified. They didn't look to see if the degrees that they were going to get would allow them to service the debt. Many more didn't even finish and get the college degree, but they had the debt. But, these are the chains that Joe Biden talks about. And they're the chains of government because the creditor is the government. And just like if you have the IRS after you, they're going to hound you for the rest of your life.
That's exactly what's going to happen with the student loans. As soon as they go default, they'll be after the parents, countersign some of these loans, and will be seizing their assets. I think that the subprime bubble is going to pale in comparison to what the student loan bubble implosion is going to happen. And it's malinvestment. Nobody's a bigger supporter, Ty, of myself in regards to education and the value of education. But the simple truth today is it no longer pays. It financially, the education that you get for what you can get as a reward on average mean the jobs don't pay enough anymore for the level of escalation we've had in education, if you look at it as a means for occupation. And so you're correctly point out it's malinvestment because there's a vast number of people that should frankly not have been in these kinds of college education courses or at college. They should have been in trade schools or some other kind of occupational training that has a payback on it. And it's all right to have the education, but when you do it and guarantee it at the level that we've done, it's malinvestment of $1 trillion proportions.
That and the collateral is their future efforts. Okay, and if their future efforts can't pay it, what do? I mean, it's just an epic, sad tale, and those people aren't going to pay that money.
They can't pay it, Ty. It's even if they want to. The jobs don't pay enough. They barely be able to control any kind of standard of living. They just simply can't pay it, and they're falling further and further behind if they have a job. And as I was reflecting here on a previous show, I was talking to a 26-year-old person who was on her 5th intern job, and then in her office, 62 people. Of that office, 2/3 of only 4 of them were full-time employed. 2/3 of them were contractors with no benefits, and 1/3 were interns. Then she couldn't see any way of getting a job that was really going to pay. And I know maybe she's an exception for some of those numbers, but it's the magnitude of the problem that we have here. So these are non-performing loans that are going to happen. Ty, we're up against our hard line, but this chart here just shows you that from distortions to moral hazards to unintended consequences, which are all monetary, malfeasance and bad practices and malpractice leads to mispricing, leads to malinvestments, and so none of this should be any surprise. And you get all of the distortions that I've labeled here on the right-hand side. And we could spend a lot of time at that. But what it all means is there has to be a clearing event. And some of it we've got to and it's normal. It's what happened in the capitalist system. I can't tell you when it's going to happen, but I can tell you this. It is going to happen, or the capitalist system can no longer function. There's nothing wrong with the capitalist system. It's just that right now we're not practicing it.
Exactly. I would say that it's not functioning at all. It's completely controlled. If you really read and know what Marxism is, and go through the 10 or 12 rules of it, you'll recognize something, and it's called Europe and the United States. And 2 of the tenets is that they completely have control of the monetary systems. And they do. And, when this cataclysm happens, Gord, we're not going to have greenbacks anymore. They're going to be bluebacks or redbacks or, yellowbacks. But whatever it is, it's not going to be the type of money it is now. And it's the same in Europe. It's the same everywhere you look. And I don't think really anybody understands the depth of the catastrophe that's unfolding, because it's unthinkable. And just, but when you sit there and you have people that talk about, defaults never happening and bazookas and we'll do whatever it takes and don't worry, it'll be enough. Those are death statements.
Ty, at the core of this is the capitalist system works if it's a closed system. That is, have risk mispriced, there's a problem, there's a catastrophe, there's a bankruptcy, there's pain. And when there's pain, people adjust their behavior. They react differently. When you have an open system and there's no pain that's inserted, behavior changes. People don't make the changes and the necessary actions that have to be taken. What we've done with our monetary malpractice, through the distortions of moral hazard, we created the an open-ended, an open system. It's not closed. And therefore, there's no pain in it. There's no corrective actions, if you would. And so it's only a matter of time that an open system leads to a death spiral. That's what happens. That's how you get a spiral, is from an open loop that I have shown right here. Ty, we're up against our hard line right now, as usual. Always goes by so fast, and there's so many more examples we could have talked about. Any closing comments you'd like to make on mispricing and malinvestments overall?
No, other than that this is the greatest example of it in history, and the bust is going to be equally as great. And you need to prepare yourself to make money as things collapse, and you'll be getting the greatest buying opportunity in history ever on most of these assets before this is over. And you need to work hard to preserve your wealth and build it during that period, so that when these opportunities happen, you're able to participate. Because, if you'd bought stocks at the top in 1929, you didn't break even till 55. But if you bought them at the bottom in 33, you had made thousands of percent by that time. And this is on the table this time, but it's 1 degree or 2 degrees greater. So get ready. Get ready for volatility. Volatility is opportunity for the prepared investor.
Ty, this is in actual fact your specialty in advising people how to do exactly that and take advantage of them. You want to tell our listeners how they could learn more about some of the things you do to protect them?
First, I help them fix their paper currencies and restore the functions of money, because I don't believe you can actually make money in any investment without fixing the paper first. And then what I do is I help them find and identify and diversify their portfolios into professional managers who have put together different techniques to find low-risk opportunities, put their clients into them in a heartbeat, and then professionally manage the risk. But needless to say, they will get long, but it's only for a trade. And if you're a long-only investor, you're walking around, you're just walking blind. You're waiting for the grim reaper. And do you need to get long? Occasionally. But this is a secular bear market that's got a long way to run. The deleveraging has barely begun. I just can't emphasize enough how the deleveraging is just in its infancy. But there'll come a days when we are all screaming in abject horror and fright. And you need to be able to take those days and turn them into an opportunity.
Ty, until we get together next month, all the best, and we'll talk to you later.
Thank you for having me, Gord.
Thank you.
This has been Gordon T. Long, editor and publisher of GordonTLong.com. New recordings are posted regularly and can be found at GordonTLong.com. New show notifications are available through RSS feed, iTunes, and other social networking venues at GordonTLong.com.